In this short video, I'm going to discuss how equity investors can benefit from using volatility control to construct their benchmarks. Equities are risky, but many investors want or need the outperformance they can deliver over bonds. We've been working on a way to manage the risk in our clients' equity portfolios that we call volatility control. What is volatility control? Volatility control is a way of dynamically managing the exposure to equities in response to changing market conditions, in particular, changing level of market volatility. We like to use the analogy of driving to the conditions. When we're on the road, we all have a natural inbuilt risk management mechanism. If we're starting a journey, and it's a sunny day and a straight road, we can comfortably drive to the speed limit. If the conditions worsen, we need to slow down slightly. And if we're driving at night on a windy road, we need to substantially reduce our speed. This isn't because we believe we are going to crash. It's just our natural inbuilt risk management mechanism kicking in. So how does this work in equity markets? Volatility control is an index construction methodology. It's a technique for risk management, and it's a passive approach to investing. It's not an attempt to outperform a particular benchmark. It's not a technique for predicting market crashes, and it isn't a technique that looks at selecting or weighting individual stocks. We implement volatility control by varying the exposure to equities dynamically in response to changes in the market volatility. If the volatility increases, we decrease our allocation, and vice versa. We rebalance the portfolio between equities and cash in order to achieve a particular target level of volatility. Let's say we're targeting a volatility level of 10%. The black line on this chart illustrates the volatility of the FTSE 100 index through time. You can see that it's incredibly variable. The red line shows the volatility that would have been achieved if we'd been employing a volatility control benchmark with a target volatility of 10%. You can see it's substantially lower and much more constant than the volatility of investing passively in equities. Volatility control can deliver better risk-adjusted outcomes than a fixed market exposure. Now, what do we mean by that? The black line on this chart shows the growth of an amount invested passively in the FTSE 100 over the last 25 years. It's generated good returns, but has experienced large drawdowns and losses over certain periods. The red line illustrates the growth of the same amount invested in a volatility-controlled benchmark. It achieves roughly the same amount of return over the period with a much lower level of risk. In conclusion, we believe volatility-controlled benchmarks can deliver better risk-adjusted outcomes for equity investors. This means that equity allocation can be maintained, but the level of risk can be reduced. Thanks for watching. I'm Dan Mikulskis, co-head of ALM and Investment Strategy at Redington. If you'd like to hear more, please get in touch through any of the contact links provided.